Liability. I'm your host, Brian Kohute from HJ Wealth Management. My co-host is Jane Scaccetti from Drucker and Scaccetti. We have a great program tonight. We don't have a guest, so it's going to be me and Jane, and we're going to talk about taxes, which is everyone's favorite subject. I always caution you, this show is taped, so obviously, depending on when it plays, talk to your advisor before you make any decisions. But with that said, Jane, nothing must frustrate you more than when your clients come in after the end of the year with all their tax stuff and say, how do I reduce my liability? So
yeah, it's much better to approach it before the end of the year.
So let's talk about planning. What can they do to reduce their tax?
So end of the year planning, there's some things you can still do. One, and people generally don't contribute to the maximum amount that they can to their retirement plans. Many years ago when I was a staff person, I did sort of my own unofficial survey and looked at the people who I thought retired successfully. Successfully was my own opinion as to how often they played golf and whether or not they seemed stressed. But almost in every case, they maximized their retirement plans and took advantage of deductions that you can get by making those contributions to retirement plans. What also amazes me is how many people who have a match by an employer won't contribute at least enough to get the employer match, which is basically free money.
How do you leave free money on the
It's
table?
absolutely free money.
And to the point, which I find, at least in my practice, is people think the max is the amount up to the match that the employer gives you,
right.
Which, as we both know, is not. That's just what the employer's giving
Correct.
you. The max is a dollar limit. It's, I believe, $17,500 for this year.
For anyone under 55. And what that you really want to do there is, I always say, give until it's very painful. Mm-hmm. That should be your first dollars that you're saving. Yep. And whether it's a Roth or whether it's an IRA, whether you're getting a current deduction or you're deferring that tax benefit to take the funds out when you retire and it's tax-free, to maximize your retirement plans is usually one of the first things we look at. And I will tell you, dealing even with very high net worth individuals, it's still amazing how many of them will say, oh, I should do that.
Yeah, no,
and it's not first.
That's our number one recommendation to clients.
The other one is charitable gifts. So, before the end of the year, and we live in a city where charitable giving is a priority for many individuals and families. So to make a charitable gift before the end of the year gives you a tax deduction.
Right.
To make it in a smart fashion is to gift appreciated securities. A couple of years ago, 2008, 2009, when I would say gift appreciated securities,
it's hard to come by.
Where are they, right?
Right.
But today, most portfolios have gains in them. And the benefit of contributing an appreciated security. So if you bought Apple and Apple's up $25 more, probably a lot more than when you pay for it, that gain never gets taxed, and yet you are permitted to deduct the fair market value of your contribution, avoid taxing the gain. And then what do you tell your clients? If they like the position, you can reinvest them.
Yeah, you can buy it back. That's the beauty. You can always buy a gain position. You don't have to worry about it. And it's a great point, especially if the clients, now we have a higher capital gains rate for some individuals with the 20% plus the 3.8%. Trying to gift that appreciated property makes a whole lot of sense.
It does. And then to some degree also is to try and see if there are any losses in a portfolio. Right. And there really aren't. And you don't wait until December to look for losses that you want to take before the end of the year, to try and harbor those losses throughout the year, so that if the market has a pullback in a year which is generally strong, maybe you take that loss, recognize the loss, and with losses, you do have wash sale rules, right. So you can't buy back the security immediately. But what I've seen advisors do is, if they sell a mutual fund, they'll buy back a similar mutual fund. It doesn't come under the wash sale rules, and yet they've stayed in the market, generated the loss to offset a gain that maybe they have already experienced or anticipating experiencing during the year. So that's not as much year-end planning, but it's part of what you want to do when you look at the end of the year.
No doubt. I mean, what Jane's referring to is your losses can offset your gains, and then you can carry another $3,000 against just your regular income and then move it all forward. Right. So yeah, it's a great strategy. People are so reluctant to take losses in positions, and we fellow CPAs, it's a tax asset. Yeah. You know what I mean? And again, you're not supposed to fall in love with your positions, right? So I use Coke and Pepsi. If you own Coke and it's at a loss, sell it and buy Pepsi.
Right.
We'll write off the taxes, and you can always buy Coke back.
Yeah. What I find are advisors like you will get them back in the market, so it's not a market-driven decision. It's a decision that will help with taxation.
Absolutely.
So there are a couple of the things that we try to look at the end of the year and make sure that you've sort of buttoned up, make sure you've made your estimated tax payments payments if you must make them. You have till January 15th for the federal one, but if you're not in alternative minimum tax, which is a whole other area, but most people know if they're in or not, then you might want to make your state estimated tax payment by December so that you can take that deduction as well. So there are the things that, you know, maybe touch base with your tax advisor and just say, okay, what are some of the things I should do between now and December 31st, and then also January 15th for that estimated fourth quarter payment.
Yeah, that's great advice. You know, I guess, as I said, people wait till the end of the year and then it's too late. So.
Well, and what's going to happen, and it happened last year, is people weren't prepared for taxes. So come April, they needed to liquidate portfolios in order to pay their tax liability for the 2013 year that was due no later than April 15th. And then by liquidating the portfolio, they generated gains. So now those gains will generate more taxes. So it becomes, you know, a circuitous problem unless you at some point plan for it.
And I think some people were surprised, right? Because last year was the first year that we had a different tax regimen, and I think people net owed more, right? So,
everyone owed more. Right. I mean, there was very few people that in fact, I can't think of anyone that we represented that actually owed less as a percentage of income. But what made it especially confusing, and what's making it confusing for most tax advisors and people today, Brian, is that the tax is not just one rate, right? So there's a rate on net investment income, there's a rate on the Medicare tax on wages, then there's a rate on self-employment income, and there's a rate on regular income. So that we actually have computed for certain clients what the maximum tax rate is, taking into account city, state, federal, taking into account the deductibility of the city and the state on the federal return. And for something like a self-employed tax rate, a lawyer, that rate could be 47.5%, 48% in total when everything is all in. That's a big number, and that's after all your deductions. Whereas for dividends and capital gain, that number drops down to more like 27.5%. So now, again, if incomes are lower, those rates go down. But for, you know, many higher net worth or higher earners, those numbers are up there.
Yes, I agree. You know, I mean, that's the nature. We're paying more in taxes, and
you need to plan more.
Right. Yeah. Absolutely. So, you know, we touched on the Roth a little bit. I'm a huge fan of the Roth. I don't know about you, but
so talk to me. So we get clients that come in, they make too much money for deductible IRAs. What is your advice?
Yeah, there's a great little loophole, I call it. You know, it's become known called the backdoor Roth, where you can make a non-deductible IRA contribution, and now because there's no income restrictions on conversions, which basically means it doesn't matter how much money you make, anyone can convert an IRA to a Roth IRA. Right. And if you don't know the difference, an IRA is pre-tax, the Roth's after tax. So the opportunity is you fund this non-deductible IRA and then turn around and convert it to the Roth. Theoretically, there's no tax to pay. I put $5,000 into the IRA, converted $5,000. It wasn't taxable.
That's your basis. There's no gain.
The only thing people have to be careful about is other IRAs mess that up.
Yes.
You know, so you have to prorate. So our strategy is most retirement plans accept rollovers. So we have our clients roll their IRA money into the 401k plan if that's what they're having. Clears the runway for these Roth conversions.
Correct.
And quite honestly, now the Roth is a feature inside the 401k plan. So.
Right, and what's happening is a lot of people will hear the amount, so maybe it's $5,500, maybe if you're over 50, it's $6,500, and it seems like small dollars, but if you show them how that number will grow, and then when you take it out, it's tax-free, it's almost like, why not do it?
You know, the rule, I think, changed in 2010, so that, you know, now we're 4 or 5 years into it, so it does add up, absolutely.
And I do think a lot of people initially just ignored it because it seemed like small dollars, and now they're sitting there saying, gee, I could have had all that money set aside, growing, tax-free, until I retire. And if you are in the lucky position of actually not needing that IRA when you retire, you can pass that on to another generation.
Yeah, I mean, you know, I became such a big fan of it, and you know, a lot of my fellow CPAs argue take the deduction now, but you know, a lot of our planning's for retirement. And when I look, if a client has all their money in a pre-tax accounts, you can't do a whole lot of tax planning for that client, can you? You take the money out, you pay your taxes.
So, you know, I used to say it's really good to use pre-tax dollars and savings in IRAs and 401ks when you're looking at income tax. Not so nice on estate tax, and not so nice when you retire. But you know, you have to balance it.
Diversify.
It's a matter of sitting down and saying, where do I want to take these dollars? What do I need? And the Roths clearly play a big role in it.
Yeah, and you know, I'm sure what you see, I see is clients haven't had a whole lot of opportunity to build any Roth money. So most clients are heavily overweighted to pre-tax, which
Yes.
is all we really had a chance of. So
now I'm not a real big fan of prepaying that tax though. So, and I know that a lot of clients, and we had a lot of people, will convert their IRA into a Roth and prepay it. And it just goes against my grain. I'm too much of a tax person. I don't like to pay a tax before it's time. And the service just came out and said that they were going to start looking at mega IRAs, that Congress actually said it, not the service. Said we're going to look at mega IRAs, and that was always the fear with the Roth. They'll allow you to convert it, and then someday they'll put an excise tax on it, and it won't be tax-free. So I think you have to do it within reason and be careful.
And I am amazed, though, to your point, that there are a lot of advisors recommending converting and paying a tax. And I guess when I look at it, is there's so many ways to build a Roth without having to pay tax. That would be the last thing I would do is convert and pay taxes.
I think where it does make sense is for, again, your sort of ultra high net worth individuals who will never touch those dollars, right? So that by converting and paying the tax, they can actually lower their estate tax. So if they do have an estate that's over 10 million on a joint, then by converting and paying the tax, that money now goes into a Roth, and that Roth can maybe go even 2 generations down with it being tax-free. So it's a different kind of strategy, but to merely convert it so that you can do a Roth and prepay the tax, still painful.
Right, because there's also people that find themselves in a very low tax bracket that a Roth conversion may make sense if you can pay the tax at a low rate.
Yep, and sometimes that happens. Sometimes we have people that'll have a startup business, and they have a lot of write-offs, and they end up with very, very low income. Then maybe converting that Roth, and you can pay it at 15 or 18% now versus waiting until you retire and being 47 or 48% tax bracket, that makes sense too.
Yeah.
It's not as simple before as it used to be, where you say, generate deductions and defer income. It's not the same.
Yeah, I agree. And I think, that's what I would challenge our viewers to is, everyone understands saving, investing, and growing your money, but when you say taxes, their eyes glaze over. They don't really understand the system. It's complicated, but it's going to matter when you retire because now it just comes out of your paycheck, and you either get a refund or you owe. In retirement, it's coming right out of your portfolio.
So, for example, we talked about alternative minimum tax, and when you're in the alternative minimum tax, your rate actually is a little bit lower, 28% versus the 39.6% for federal. So there may be an advantage if you are in the alternative minimum tax because you're living in New York City and New York State, or you're living in Philadelphia and you have high city and state local taxes. But you anticipate when you retire, you might be in a higher tax bracket than you are now, and sometimes that is going to happen. People keep assuming it'll be a lower tax bracket, but laws changed. So a lot of people who started their retirement plans in the last 20 years are in a higher tax bracket today when they retire than they were a few years ago. Well, then it may make sense to pick up the income in a Roth conversion. But again, you need to run the numbers.
I say that all day long. Got to run the numbers. The numbers don't lie. So, a lot of our clients are business owners, as you are. What should they be thinking about?
So what they're all thinking about right now is whether or not Congress is going to pass the Tax Extenders Act. And the main areas for that are bonus depreciation, 100% tax depreciation, expanding the Section 179, the deduction for capital expenditures, the R&D credit. They're probably the big ones, and the one that everyone loves. It's the IRA, the contribution directly of your required minimum distribution to a qualified charity. So Congress, the last couple of years, has extended those provisions, but this year it's even more difficult. There was one that was passed by the House, or at least introduced by the House, a couple of days ago, but it only handled the business side and not the individual side, so it was rejected by part of Congress. There was another one that's trying to be introduced now, so hopefully by the time this airs, maybe we'll have more clarity, but that's a big number for a lot of businesses to be able to invest and deduct 100% versus the 179 limit, which is $25,000 right now. Having it virtually unlimited will be a major issue. So I think many of them are thinking about that. The other thing is making purchases and placing the property and service before the end of the year. So a lot of technology updates, buying computers and printers, and as long as you have them purchased and operating before the end of the year, then they would qualify for depreciation, even if the bonus depreciation rules are not passed.
Yeah.
So,
don't you love when a client comes and says, I need to buy something, I need a tax write-off, and you're like,
right.
well, what do you need? I don't need anything.
Right.
I'm like, well, the tax rate's not 100% yet.
So one that we've spent a lot of time with clients is the de minimis rules for the repair regulation. So, if you made repairs and maintenance, whether or not you can deduct them as opposed to capitalizing them. And some of them come under the de minimis rule. And again, this is one of those areas where when you look at it, you go, well, that sounds pretty small. But then as you start to see it, taxation, and I say this to our staff all the time, it used to be when I first started, you had one great idea and you'd save somebody $100,000 in taxes. Everybody'd say, Roth, right? It's not like that anymore. There's small pockets where you start to keep cutting and cutting and cutting. Yep, you do.
I heard they simplified the home office deduction. Do you envision a lot of people are going to opt for that? They call it the safe harbor?
Yeah, and most people do. I mean, the problem is you still have to come under the exclusive use, and you still have to, make sure you're meeting all of the requirements. I don't think it's as much of a flag as it was a couple of years ago, because you can come under the safe harbor for the home office. But you do see that. I mean, you do have a lot of people who use their home for the convenience of their employers and meet all the requirements that would permit it. So if it's allowed under the law, it's something that you should explore. It's like the vacation homes.
Right.
You get 14 days. If you rent your home for 14 days or less, you get to keep the rent and don't need to report it. What happens is people figure out they can rent their home more than 14 days, and now they get into the complex rules of passive activity losses and rental real estate, which then requires people like me to come in and figure it out. But there are little areas where you can maybe make some significant savings only because they all add up.
Yeah, do you find, we talked about retirement plans, a lot of your clients have retirement plans, or I know there's studies that 40% of small businesses don't even have one?
So, for small businesses, they just need to understand the impact of having a plan, right? So if it's a cash basis plan where basically your employees are making a contribution, that's fine. Where you sometimes find employers will get in trouble is because they'd like to do more for the owners of a business, and the law really prevents you from disenfranchising the lesser paid employees. So what you end up with is an expensive plan, right? And then you have to weigh the benefit of having that plan. But I would say most small businesses today still have some form, even if they're simplified employee IRA plans, that they will contribute to for themselves, and then if they have employees, put in some kind of 401k plan.
Great.
So I think I think they need to do it to be competitive in the workforce.
I think so, I agree. So you have time for a question, Jane?
Yes,
so
I
believe
do.
It's about Social Security. So the question is from Kelly Roberts from Ardmore: is it lawful in the Social Security program for the government to lower your income from year to year? And I think what the viewer's asking is, the Medicare premium that you pay that comes right out of your Social Security check is tested based on income. So it could go up and down year to year based on what your prior year income was.
So I'm not a lawyer, so I can't tell you whether or not it's legal for the government to do it. And I apologize, I'm not familiar with the rule under the Affordable Care Act that probably allows for that. But if that rule does come under the Affordable Care Act and allows for that amount to be adjusted, then I don't think it's so much they're decreasing your income as much as they're increasing your cost.
Right.
And even though that nets to the same answer, I think that sounds like something they're entitled to do.
I agree, because you probably remember a long time ago they fought, was Social Security constitutional because it's technically a tax on a tax?
Correct.
They got around that one pretty
very easily. They called it excise and not
that's
income.
That's right. It wasn't income tax, and away we go.
Yep.
So, and I think
definition.
I think what people will be surprised is that, depending on your income in retirement, Social Security may be taxable to them.
Correct. And I was thinking when you read the question, if that was part of it, some of it will depend on your total income as to what portion of it is taxable. Right. So from one year to the next, if you have a lot of capital gains, you could force more of your Social Security income to be taxed versus a year where maybe you've netted those gains to zero.
Yeah, no, it's a great point. I think, we do a lot of tax planning for retirees because I don't think they're prepared that, as they take distributions, every distribution, as you said, potentially has a different tax consequence to it. So really figuring out your buckets of drawing money down really matters. what else are you telling clients about taxes? What questions are you getting? Are you getting a lot?
So where I'm also getting is there's a lot of confusion about home mortgage interest.
You can deduct it all, can't you?
I know. So the law says that you can deduct the interest on up to $1 million of mortgage that was used to purchase or substantially rehabilitate your primary and second residence. And then you're allowed a $100,000 line of credit, interest on $100,000 that is held as a line of credit. So we call it the $1.1 million limit. Mm-hmm. What we have done too, sometimes taxpayers, especially those who don't necessarily need to have a mortgage, choose to have a mortgage because interest rates are so low, and then they'll use their money to invest. For those individuals, there is a regulation that you can elect to not treat your home mortgage as home mortgage interest. And then the question would be, what did you do with the funds? And if what you did with the funds was invest them, then that becomes investment interest. Right. And that investment interest is under a whole slew of other laws, under Section 163 of the Internal Revenue Code. But the beauty is that it is deductible for the new NII tax, the net investment income tax. Mm-hmm. So you might be able to take that 3.8% tax down, as well as reduce your general taxes by having something that is interest deductible, instead of being interest deductible as a primary home mortgage, have it deductible as investment interest. It's complex, it requires an election, it's not something to do on your own, it should come with a warning.
Yeah, right. Is it a one-time election?
So once you make that election, you must follow through with that forever. So you have to really think through what the ramifications are of doing it. So the other thing that we're seeing is people actually getting ready for 2015. And what should we look at? What should we do? And one of the first things that I tell people is, one, plan for cash flow. Right. You don't plan for taxes, you plan for the cash flow to pay the taxes. And if they don't, then they're not doing you any justice, because you're trying to invest in their portfolio and see what kind of return, and they're pulling money out at inopportune times.
Sure.
The second one is to keep good records. Most of the time, people just get sloppy in their record keeping. Mm-hmm. It's gotten a little bit better because of the use of technology, right, yeah. But it's still not what it can be. And many deductions go by the wayside because people are not being as organized, or not doing it 2 or 3 times a year, but try to wait until one time a year and one long weekend, and probably need 1 bottle of wine to get through, right, figuring out all your charitable deductions. And then the last thing would be to start to think about estate planning. It's not so much about the taxable estates as much as being careful that you are planning for whatever you've built up in your lifetime that you want to leave to your children or your heirs, that you're doing it in a responsible manner, and maybe protecting it from creditor claims. Right. And with a lot of divorce, a lot of marriages ending up in divorce, it's something to consider. What most people will do is they will set up trusts for their children, and the trust will pay out at age 30, 35, right, and 40. And if you think about what age most people get divorced, you've right suddenly made something. Yeah, right, yeah. And unless those children are really keeping them in separate accounts, et cetera, that inheritance gets mingled, right, becomes a marital asset. And there's a simple way around it. There's ways to use trust that will stay on, and the individual can be their own trustee. They're the kinds of things you want to be talking about with your advisors come the beginning of 2014.
Yeah, and what we found was, everyone kind of brushes off estate planning because, oh, it's $10 million, 5 each, I don't have to worry about it. But they forget all the state, right? Because the states don't follow the federal rule. Like PA has a different rules right in New Jersey, and it can add up if you have accumulated some money.
It adds up considerably. And they also don't consider estate planning as being good stewards of their wealth. Right. And that's the second piece of it. The other piece that we see right now are people changing domicile or residency and trying to figure out where they are a resident. And with states hungry for dollars, they are, going after, did you breathe the air of New York? Right, did you just pass through? Right, like if you pass through on the train, that's fine. But if you stopped and had dinner, you may have spent a day in New York. Most states have the statutory minimum, we call it 183 days. If you've been in that state 183 days, you are taxed in that state. You can be both domiciled in 2 different states and pay taxes on the income to 2 different states, and that can happen. Mm-hmm. So it's very, very careful. And generally there are rules about how do you establish residency. A lot of people from this area will go down to Florida, right, and the cleanest way is they've sold their home in New Jersey or Pennsylvania and moved to Florida. Sometimes they maintain it, have a second residence, and now they want to claim Florida as their residency. They think if they fill out a domicile paper, that's it. And then they say, well, I changed my license, that's it. And these are not the rules. The rules really do look at whether or not you've changed, where does your family gather, where are you active in the community. And they look at things that are very, very specific as to where you spent your holidays, what charities you supported, where they were domiciled.
Right?
Yeah, the voting, most people get that they've got to vote, they get their car, and they get the domicile paper, and then they think it's over, and it's not. So there's a lot more that needs to be done. So they're the kinds of things that we're looking at year end. How about with you in the investment arena? What do you look at for year end for your clients?
And pretty much the same thing. We look at cash flow for the next year, try to get estimates. We try to do the tax loss harvesting if there's any possible. And a lot of what we're doing now is funding, looking to make sure people maxed out their 401k, because a lot of the IRAs aren't due till you file your taxes, but in the retirement plans, your deferral has to go in before the end of the year.
Right, the cutoff December.
So we find people miss that, so we try to get them to max that out. The other thing I'm getting a lot, and you probably are too, is HSAs, health savings accounts, are becoming very popular, which in theory I'm a big fan of, because
if you use them.
Double tax-free, right? It's tax-free going in, tax-free coming out. But that's my question. Is it going to be more smoke than anything? Because people are just spending them down, right? They're putting the money in and then they just pull it right back out.
Well, and correct. And sometimes they're not spending it down and then they lose the ability to spend it. So it can get complicated. I mean, again, I like to try and keep things simple. If it's going to be something that becomes more aggravating and cause more angst, then I would prefer not to do it and find other ways. But you're right, they're a benefit. And with the Affordable Care Act right now, generally if you have health benefits through your employer, you don't have to worry about it. But if you don't, you should probably be talking to someone to make sure you're not coming under any
mandates.
It's
complicated.
It really is, and it's not something you can easily discuss, and it's really fact-driven. So you must sit down and talk to someone about your particular facts.
Yeah, the other thing, another opportunity that the IRS just sort of blessed was, we talked about funding those non-deductible IRAs and converting them, but what we also found an opportunity is for people that had these legacy non-deductible IRAs, where they just did it, never took the deduction, but now it's all commingled. It's commingled with regular. There's another opportunity now where they can bifurcate that. They can put the taxable portion into their 401k and then turn around and convert that. I've been doing a whole lot of that here.
If the record keeping is there.
As long as they told their accountant who followed the right forms, that makes it easy.
The record keeping is not there. The other one we're seeing in the LGBT community is with more and more, if you were married in New York and New York permitted marriages, but you live in Pennsylvania, you can still file a joint return for federal. And the states in Pennsylvania, filing a joint Pennsylvania return doesn't give you any benefit more than if you and your wife had tax returns to file separately. So we're seeing a lot of confusion in that community about what is best to do. Sometimes people will be an alternative minimum tax and say, well, I've given the exemptions to my partner, but the partner is in alternative minimum tax and not getting a deduction.
I'm going to have to stop you there.
Okay.
I guess the message is, taxes are complicated. You need to sit down with your accountant and do some planning.
Right.
Please join us next week. Our guest is Matt Bloom. He's the CEO of Crime Watch Technologies. And Money Matters is now available as an audio podcast on iTunes and Stitcher Radio. It's listed as Money Matters. Please join us next week. As always, your money matters. Thank you.